So, in terms of the district, so I'll talk about Minnesota, but actually a lot of what I'm going to talk about extends to the district as a whole. So the district, as Claudia mentioned, consists of Montana, the Dakotas, Minnesota, the Upper Peninsula of Michigan, and northwestern Wisconsin. So the bulk, that's about 9 million people, and 5 million of those people live here in Minnesota. So if you think about Minnesota, certainly we suffered from the recession. So in December of 07, I think our unemployment rate was probably right at 5%, and it peaked in the summer of 09 at about 8.4%. Now it's come back down now to 5.6%. So how does that compare to the nation as a whole? So the nation as a whole, unemployment peaked at around 10% in late 2009, and is now down to 8.3%. So the recovery, just in terms of unemployment, has been much stronger in Minnesota. And this is something you'll see if you look at the Dakotas. I think these, especially North Dakota, it's much even more strong recovery because of the benefits they've had from the strong oil industry in large part, and a strong ag as well. So that's our outlook here for Minnesota is, I would say, similar to what we've seen in the past. Continued recovery, maybe at a pace slower than we'd like to see, but a continued decline in the unemployment rate, among other things. One of the things that I think is interesting when you look at Minnesota is I've been focusing on the unemployment rate, but I think it's interesting to look at the fraction of Minnesotans over the age of 16 who have a job, the so-called employment to population ratio. And that's always higher in Minnesota than the country as a whole. And it's not easy to understand exactly why. At least we don't have a ready explanation. I think part of it is due to the fact that our population is more educated than the nation as a whole, but I think that's only part of the story. But that fraction of Minnesotans who had a job peaked in the late 90s or early in 2000, and really has been coming down relatively steadily since then. It came down very rapidly in the recession, but it's been a decline since that point. We've actually seen a little bit of an uptick relative to the base that we hit during the early stages of the recovery. But in general, we've seen this strong decline. Now, why is this interesting? Well, it really makes you think about, at least makes me think about, what's happened at the national level. So the national level, the same fraction of people over the age of 16 who've had a job has fallen precipitously from where it was in December 07, which is around 63%, down to around 58.5%. And it stayed at around 58.5% since late 2009. There's really been no market improvement in that at all. And the question we face as policymakers is there a policy choice, a change that can be made in order to boost that fraction of Americans that have a job or not? And that, when you look at, when I think about Minnesota and the experiences we've had, I think that it reinforces the importance to try to think about this question. So, basic punchline for, I think the recession was not as hard hit. It did not hit this 9th district as hard as the rest of the country. We've recovered more rapidly. There's still further room for improvement. Yeah, sure.
So I'm just wondering how much of that could be accounted for as a result of productivity changes rather than like that moving from 63 to 58%. Is that
at the national level?
Yeah, doing better with being more efficient.
Well, so part of it is I think that there's definitely productivity improvements, but in general we think that if productivity improves, that should stimulate more hiring because you're able to. If people are more effective at doing things, that should lead you to hire more of them. So there's an ongoing question, a discussion about to what extent is this due to changes in the kind of work that corporations are demanding, people are demanding from the workforce of the U.S. The possibility that taxes, the future taxes, changes in regulation are constraining hiring by firms. That's sort of on the one side, what are grouped into supply side kinds of considerations, or the fact that because of the decline in wealth and net worth that we've had since 2007, demand has fallen so much. So it's really a connection, the dialogue about what should be done with policy is, should we be thinking more about the supply side? That's really a longer term kind of question. Or should we be thinking more about what's going on the demand side? And that's really more a short term kind of question. And that's the dialogue that I think you hear ongoing among policymakers of all stripes, including among the FOMC.
I got one here, Toby.
I was listening to a radio station I don't normally listen to, so I don't know how reliable it was, but they were saying that the entrepreneurial rate has dropped precipitously in Minnesota in the last, I don't know, recent period of time. And I'm wondering how you would respond to that if that's true, and then what can be done in order to prompt more entrepreneurship to stimulate our economy.
So this is and there are people in the room actually from our public affairs and community development staffs who probably know a lot more about this than I do. But this is something that's actually happened at a national level as well as within Minnesota. And what you see is that there was, I would say, a relatively steady decline in the rate of new business formation, which is the way I'll think about entrepreneurship. And then beginning in 2006, really a really sharp fall off and not much of recovery along those dimensions in terms of the rate of new business formation. And I think this really matters when you think about hiring, because often new businesses are an important source of getting of hiring in the economy. And so that decline in entrepreneurship and decline in new business formation, I personally think is very important in terms of thinking about the fact that the number of Americans that have a job is so suppressed compared to where it was in 2007. Now, what can be done? I think from the Federal Reserve's point of view, keeping interest rates low, as we're doing right now, is a way to stimulate more people to think, okay, instead of saving my money in the bank, I'll invest it to get that higher return than I'll get from starting a small business. So that's the stimulus, and as well with keeping borrowing rates low for people to borrow to try to start that small business. So that's what the FOMC, what the Fed is trying to do along those lines. I think it's a very challenging problem in the wake of, at a general level, in the wake of the kind of shock that we've had to wealth, to net worth. You think about all the decline in housing value that we've taken. How does that translate into to entrepreneurship? Well, the Federal Reserve does what's called a survey of consumer finances every 3 years. It just came out, some summary statistics of that just came out a couple months ago. The median net worth of households in the United States is back to where it was in the early 90s. Now, why does this matter? Well, net worth is what you need to start a business. If you don't have net worth, it's going to be hard to get that business, to have the capital to start a new business. So I don't know how you're going to start to see, and it just becomes these things feed off each other. Why are people going to start a business without having an improvement in the economy? But I think that for me, the solution to this chicken and egg problem is we need to have some stabilization in housing prices, some feeling of stabilization in net worth before you're going to start to see people feel confident and comfortable to start those new businesses. I don't know if that's helpful.
Sure. I'm Alana Casera, and I am a graduate student teacher candidate at the U of M. And I'm wondering what you would say to a student who, after we're learning about investments and things like that seem like something that might not be a part of their lives, that for them it's going to be a challenge enough just to not be living paycheck to paycheck. Why is it important to learn about investments and learn about monetary policy and fiscal policy?
Well, I think this is a very good question. And I think that the starting point for it is that investment offers the hope that you will not be living paycheck to paycheck. That the way the way one overcomes those circumstances, and I think there are a lot of role models that one can point to that along those lines, is through education. Education is, as the chairman talked about, the ultimate form of investment. So I think investment is, at a very basic level is, and when we talk about financial literacy, we often talk about saving, but I think it's useful to make a distinction between saving and investment. So saving, I think about you put your money in the stock market, put it in the bank account, and just let it accumulate. Investment is really about building something. And the kind of investment that all of us do throughout our lives is human capital investment. And I think getting people into the mindset of thinking about if they are willing to give up a little bit today, they can get something in the future, and make that stream of payments they get, their incomes they get from their jobs higher. That's why, then I think that's what investment offers for you, is that hope that you will not have to be in that situation anymore of living paycheck to paycheck. But I'm sympathetic to the point that until you get people into the feeling that they are fully integrated into the economy, a lot of the things that we talk about in monetary and fiscal policy are going to seem very abstract. I think, and you guys, men and women, are on the front lines of trying to, I think, inculcate the importance of personal financial literacy, which I think is the first step to getting people to the kind of incomes where these kinds of conversations about monetary and fiscal policy seem much less abstract to people at that point. So that's the way I would think about that.
I'm Jean Kyle from the Minnesota Department of Education, where I work as the Business and Marketing Curriculum Specialist. My question is, in Claudia's introduction, she talked about your interest in tax design.
Yep.
I'd like to hear about that.
Well, you should really wait for the movie to be made in my book. No, so I spent the last 10 years thinking about the issue really of social insurance and incentives is the way I think about it more. And how in a world, a dynamic world, how best do we think about setting up our tax system to provide dynamic incentives so that we can provide the best kind of social insurance. And whereas, to give a concrete example, and this is really not my work, but work that was done by a couple students who were working at the University of Minnesota, is should we be asset testing when we provide social insurance? So that if, right now, for example, in the United States, if you, for many kinds of welfare payments, you really have to maintain a relatively low level of assets. If you have too high an asset position, you won't be eligible for that. Is this a good thing or a bad thing? And this work shows that from the point of view incentives, it's a good thing, because you don't have to worry about people accumulating a lot of wealth, quitting their jobs, quitting work, and then going on social insurance. And so because you're deterring that incentive, you're able to provide more social insurance. So that's the kind of work I did. I think that this is just an area of enormous vitality in economics in general. The American Economics Association gives a prize every year now called the John Bates Clark Medal that's given to the best economist under the age of 40. The guy who won, I guess 2 or 3 years ago, Emmanuel Saez, is a public finance person. And he's done amazing work on measuring inequality across people, both in our own country and around the world, and then thinking about, well, what does that mean for tax systems? What does it mean for taxation at the very high end? And so I think there's just an enormous amount of work that's going on in this area that's tremendously interesting. My own work tends to be couched in probably an overly technical way, so I'm not sure I would encourage you to be looking at it. But the introduction to my book is available free on, if you're on Google. So, and I think the introduction actually lays out some of the issues involved pretty nicely, and then the rest of the book is not as interesting, I don't think.
You want to see if we have someone at Helena? We could ask.
Hi, do you want me to go ahead and ask? Hi, this is Leslie and Helena, and Connie Ganger from the Montana Council of Economic Education had this question. The growth of smaller banks in Montana has been dramatic in the last 2 years, yet the economy hasn't experienced astounding growth. Should there be any cause for concern about the stability of these financial institutions?
No, I think that this is just, it's just an ongoing. I don't see anything just in those two facts that make me concerned. That's a situation where right now loan demand, I think, around the country remains relatively low. We're starting to see some pickup, and so those two facts alone don't give me any cause for concern.
With the change in demographics, we used to have about 40 people paying for Social Security and such, or as 40 people for one, and now it's going to be 2 to 1. Do we just need to take a whole different look at how we finance this? Is anybody looking at that realistically about, we just can't finance it the same way at all?
So there's an enormous amount of work going on this, actually, and I think that it's on the Social Security dimension. Here I'm reading it as an outsider to the literature, but my reading of this is that relatively small changes to how we do Social Security would allow it to maintain its solvency, even in the face of the demographic challenge that you're pointing to. I think Medicare is another issue. So I think that being able to sustain the medical care at the for the group that we're going to have in that older age group, for people who are going to be living as long as I expect that group to be living, is going to pose a real challenge from a fiscal dimension, and that's going to be a choice that the citizens of the country are going to have to make about what level of medical care do they feel committed to provide to people over the age of 65 and beyond, and that's going to depend on how much they're willing to pay for it through taxation. Well, on the Social Security front alone, I think there are changes in retirement age and that kind of on funding that I think are not that large that can actually sustain the viability of the program. It is more about because of the growth of healthcare expenditures and also a good thing, the lengthening of life expectancies, I think pose a bigger challenge for that. The answer to it, a big part of the answer to this is to get our children educated so that they can earn enough so that we can tax them and pay for these. But a serious way the way to overcome the demographic challenge is to endow the pool of people that are working with sufficient skills. Then then that bulge that's retired isn't that big because the people behind them are earning so much money or are generating so much output.
The final question is reserved for Claudia. So.
Oh, I'm going to give you your choice. We didn't get to hear Chairman Bernanke's response to the impact of the Euro crisis on our economy. And the other thing is, I've always wondered if, in your discussions at the FOMC, you even take into consideration the severe financial issues that it's facing California, which is a huge economy, and if that even comes into your consideration at all. So you can choose whatever.
So I'm willing to talk about both, I guess. I mean, so I think that in terms of the Euro crisis, I think the chairman touched on the 2 ways that the European challenges could impact our own country. One is through the fact that if Europe goes into recession, the demand for our exports will be lower. This channel is relatively weak in the sense that trade is a small fraction of GDP for the United States, and then the European trade is even a smaller fraction, obviously, of international trade for the U.S. So that I don't think of that channel. It matters, but you're talking about 0.2, 0.3% kind of growth kind of figures. The big issue is more about financial market transmission. That if they had a financial crisis in Europe, how would that spill over into the United States? That's something we're watching on an ongoing basis. It's important. Matters for monetary policy. It really matters more on the supervisory dimension, more that you want to make sure that we're insulated against that kind of shock. And right now, financial markets are sending the signal, we were just talking about this today at lunch, that financial markets are sending the signal that they have confidence that we're doing a good job on that dimension. Because if you look at measures of financial market uncertainty, those are relatively low right now. But that's the bigger channel we have to worry about, and but I think of that as being even more of an issue for the supervisory side than for the monetary side. Your other question is about California. You mean the fiscal issues in California? I don't. The way the Federal Markets Committee works is that each president of the 12 will present some information about the local economic conditions. I will do that, and the president of the San Francisco Fed will do that. And I think, though, that will end up generally just being bundled. California's troubles are ones that are being felt around the country, as the chairman talked about, in a bunch of states. And so I think that I think we tend to aggregate those up into being more the downward drag imposed on the recovery by what's facing state and local governments. We don't have anything specific that we, one of the challenges for the Federal Reserve, and this, I think Ms. Roberts asked about the limits to monetary policy, that the Federal Reserve was extremely creative under Chairman Bernanke's leadership in the 2008 to 2009 time period to deal with the financial crisis. And I think and rightly so and appropriately so, but I think it's left people with a feeling they don't know the boundaries of what we can do. So people might ask me, or more likely to ask President Williams, the president of the San Francisco Fed, about what can the Fed do for the state of California with this? Some idea that we can somehow rescue California from its fiscal travails. We can't. We don't have that ability. But I think it's become, people knew what the Fed used to do. It was about raising the interest rates up and down by 25 basis points, and that was it. And now, in the wake of 2008, 2009, it seems like the Fed could do a wide range of things. Who knows what they could do next? And that's tough to, you can tell people, go read the Federal Reserve Act, you'll figure it out. But that's not a really useful answer. So. But thanks a lot for your questions, and thanks. I personally got a lot out of listening to the chairman. But I'm sure you did too. I thought it's a great opportunity for us, and so I thank you all for coming.